For all of you joining us live and the number of you joining us on the replay, thank you for sharing your time with us for our My Wealth video series. My name is Jeff Hunter and I'm Portfolio Manager with the Townshend, Somani and Hunter Group at Canaccord Genuity. Also on the line are our lead investment advisors, Raheem Somani and Dave Townshend. For more information about our team, our process, and our extensive My Wealth global portfolios, please check out mywealthmanager.ca. Today's call is with Kevin Vandermeer. Kevin is a highly recognized portfolio manager and also recognized as both a Lipper Fund Award winner and TopGun Investment Mind. Kevin, great to have you on today.
Thanks for having me back, guys. It's good to be here.
So with that in mind and just conscious of your time, let's dive right into it. I'll bring up the presentation here and go from there.
Perfect. So I think the focus today is to look at some of the global markets and then look at a couple of portfolio solutions, one of them being an ETF portfolio and another North American portfolio. So I have also with me Meng Gao, who works alongside me, and he's going to be presenting part of the presentation today as well. So, but yeah, thanks for having us. So what we'll do is start off the presentation by just looking at international markets globally. So if we go to the next slide, and if you look on just a one-year basis, you can see that actually Canada is one of the top markets in the world, kind of among G7 countries. The US right behind it, and then sort of emerging markets in China is really lagging. And if we had looked at this chart 1 year ago, you would have seen that Canada was one of the laggards and China was actually one of the strongest markets. And we're going to talk a little bit about China. There's a number of reasons for why it's struggling. They're obviously making some changes geopolitically, but there are also some bigger challenges, mainly around the Delta virus. Big parts of China are now going back into lockdown, and that also is going to have some implications to the supply chain. But really what we want you to take away from this is that Canada is one of the top performing markets on a one-year basis, and actually China is one of the more challenging markets. Then what we like to do is show you what sectors. So we just showed you that the US is one of the best performing markets globally, but what sectors are performing well? And as we think about the economy is really reopening in the back half of this year and already starting to, it's not surprising that you would find sort of a cyclical sector like financial starting to do better and performing well in advance of that. And really, the focus there is just around loan losses. With the economy opening up, or economies, a North American economy opening up, there's less of a chance that banks are going to have to write off bad loans on companies that aren't performing. And you'll see communication services is primarily Google, which is obviously benefiting from a lot of the work at home and a lot more online activity, whether it's spending by companies that are buying advertising as well as people that are searching for things. So not surprising that kind of communications and technology in general are some of the stronger sectors. Now we look to Canada, and again, not surprising that some of the more cyclical sectors are stronger. Energy, obviously, again, if we looked at this same chart 1 year ago, you would have seen that energy was one of the weakest sectors. But energy is starting to move, as has the price of oil. At one point, the price of oil went negative, which is something that's hard for all of us to realize. But as people are driving more, as we start to fly more, all of that activity has moved the price of oil up dramatically. And now we're sort of around the high 60s and low 70s. And, obviously that's good for energy companies. And again, Canadian financials, similar to the US, are benefiting from an improving overall economic environment. You'll see here that the sector that's lagged the most has been materials. And within materials, you really have what are more defensive areas like gold producers. So the price of gold has struggled. And as a result, gold companies have not performed well. There have been some base metal companies that are more levered to copper that have done well, but as a whole, the sector in Canada is predominantly weighted towards gold stocks. And as a result, the material sector in general has underperformed. In terms of commodities, this kind of just highlights what I just talked about, but you can see natural gas and WTI on a one-year basis have performed very well. And as I just commented, gold and silver have been somewhat challenged. Then as we look at fixed income, you can see that the price of, even if fixed income was under pressure earlier this year, with real fears of inflation. And if you've got sort of a coupon that the best you can do is maybe 2% or 1.7%, and you've got inflation running at a much higher level, bonds are going to sell off. And what we saw was, governments and corporates really sold off hard. They're coming back, and then high yield has done much better and has been really the place to be. And high yield tends to perform more like equity. So it's not surprising that that would be outperforming, especially in an environment where inflation is a concern. So now I'm going to move into, so we sort of walked you through some of the bigger buckets, if you will, in financials globally. And then I just wanted to hit on the next 5 slides that I have. We're really going to hit on some of the key financial themes that people are talking about. So one of them is inflation. And, I recently got my haircut in Toronto, and the price of my haircut went up by, I think, $3. So I'm paying like $25 at the barbershop now. And you see it kind of everywhere. The price of things are going up more dramatically than we have in the past. But what this highlights, and so the debate is, is inflation what's called transitory? So is it only for a short period of time and we'll get back to normal, or is it stickier and potentially, we're all going to be paying more for things? And so what this chart shows us is things that have, gone up a lot or have high inflation rates right now are in the energy and the transportation area. And they have, even though they've gone up a lot and are quite expensive right now, when we calculate or how the government calculates inflation, they actually are very small parts of it. The biggest part of the bucket, if you will, or basket of goods is shelter and food. And so you can see that on the graph, those are larger components, but actually the inflation associated with those is quite low. So the Federal Reserve, and to a lesser extent, the Bank of Canada, is really hoping that inflation is what's called transitory, so that it's not going to stick around, and we'll have it drop down to more normal levels, which are about 2 or 3%. Now, the other great debate that's happening right now in finance is people say growth versus value. So when people talk about growth, they really mean sectors like technology, sectors like communications, sectors that have typically are more expensive and are growing quicker. And more value-oriented sectors in the market are, energy, materials, and to a lesser extent, financials and utilities, if you will. And so you can see since the Great Credit Crisis and financial crisis in 2008, value has dramatically outperformed. So where you would have benefited most would be really in the US market and to be overweight technology. And that's really would have been the best place to be post 2008. And then there's been other areas that have been much more challenged, like energy and materials to some extent. And so for many, many years, value investors have been hoping that their approach and their philosophy will start to work. And we saw that, the first evidence of that late last year or the middle of last year, where value began to outperform. And then what we've subsequently seen is that that's starting to roll over again. And so it's definitely something that we think about. We had our strategist, Tony Dwyer, on a national call for our advisors today. And again, that was a topic of conversation and something that, investment professionals within Canaccord think a lot about. The other thing we like to highlight, or something I'd like to highlight in the presentation, is what we call seasonality. And so what this chart shows is that if we look at markets, take every market since 1990 to today, so roughly call it 40 years or 30 years of data, and we lay those 30 years on top of each other, what we find is that the market will typically go up starting in January up until the middle of the summer, sort of July. And then for whatever reason, there's lots of people that come up with reasons, but the market will tend to go sideways or even down to the end of October. And then we'll typically rally into year end. And many people call that what's called a Santa Claus rally, sort of like late November, December. So one of the things that we think about and talk about right now is, because the market is elevated, meaning it's at all-time highs right now, and we're going into the most seasonally weak period of time, we remain kind of cautious on the market right here. So if you were a poker player or a gambler, you would look at probabilities. And so we do the same thing in markets. We look at what's happened in the past, and right now it's a seasonally weak period of time. So we remain as a firm a bit cautious right now. And then, I've got two more slides. Both of them focus around the recovery in the market, how quickly the markets have recovered off the bottom of in March of last year. And so amazing that typically, it will take you kind of 2 or 3 years for a traditional market, after it's sold off like 20 to 30%, for it to kind of get back and recover and its loss. And what we're seeing here is that this market's actually recovered. It's been one of the fastest recoveries out of a kind of a bear market. And part of that is because the Federal Reserve and governments around the world have put a lot of capital and a lot of money into the market, more than we've ever seen before. So the response shouldn't be that surprising, but I think it's important that we look at what other bull markets have done in the past, and how does this compare to it. And the thing that is foremost in our minds is that this has been one of the fastest recoveries. And then this kind of makes the same point, and that is that typically, it would take sort of 40 months for us to get sort of from a bear market to kind of a bull or peak market. Usually takes us 40 months. We've done it in 16 months. And on average, like kind of bear to bull, you usually get about 125% return. So kind of almost over 3.5 years or almost 4 years, you would get that kind of return. And we've seen it in 16 months. So It's another reason why we remained a little bit more cautious than we normally would, because we've had this great move off the bottom. The speed at which the move is, the speed at which the recovery's transpired is much faster. And then we're sitting at kind of all-time highs going into a seasonally weak period. So, this kind of highlights the importance of having investment professionals like we have here on the line that can look at your financial goals. If you have short-term goals of buying a house or something like that, or if you're funding your retirement, which would be longer term, it's important to have a plan, because understanding some of the nuances of the market right now and some of the challenges, especially as we think about the next kind of 3 months, might dramatically impact the type of investment products you might make and the type of investment plan you might come up with. And one of the things that we pride ourselves in at Canaccord is having bespoke solutions, so solutions that are tailored specifically for you to meet your financial goals. So with that in mind, I'm going to transition to my colleague here, Meng Gao, who works alongside me, and we're just going to walk through a couple of products or solutions that you can use alongside, having a financial plan to really meet your financial goals. So I'm going to hand it over to Meng now.
Thanks, Kev. And hi, everybody. I apologize in advance if you hear some background noise or some construction today, but great to be here. My name is Meng Gao. I'm a senior associate here at Canaccord. I work alongside Kevin Vandermeer, and together we manage a few portfolios for advisors here at Canaccord. And today we'll be going over specifically 2 of them. So the first portfolio we'll be going over is the global ETF portfolios. And really this portfolio is for clients that are looking for exposure on a global landscape, but through a balanced approach. And what that means is each portfolio has both a fixed income as well as an equity component. And really, we designed these portfolios really thinking that it's meant for your safe money, if you will, a place to park it. And if you think about it, with the fixed income piece on the down market, it really kicks in and ideally protects the portfolio. And on the reverse, vice versa, the equity piece will pull the portfolio up when the markets do well. So on this slide here, sorry, can we go back a slide, Jeff? Yeah, so on this slide here, just like when you apply for university or apply for a new job, they ask you for your GPA. So we're no different. We like to start off with the performance right up front. And as you can see here, this is as of July end, the latest numbers. You can see month to day, year to day, since inception, all the portfolios are in the green. They're positive, they're trending very well to finish the year off strong. And you can see 6 portfolios here actually. And really these 6 portfolios are just variations of one another. And together, these 6 make up what we call the global ETF portfolios. And depending on what your risk tolerance is, what your investment goals are, let's say you're looking for retirement and you want something less risky. So you might be looking for something with more fixed income allocation. Then you probably be looking at the most conservative lineup that we have, which is the conservative at 40% equity and 60% fixed income. And then the most aggressive that we have is a capital appreciation at 80 and 20. On the next slide, I know it looks very busy, but it really is just showing you all the holdings that are in the actual portfolios at the moment. And if you take a step back, you can see the 6 portfolios that I just mentioned previously labeled at the top. And how you can think of them is really think of them into 2 buckets. So the equity buckets as well as the fixed income buckets. And then near the top half of the page, starting from Canadian equity, you can see we have a large carve out towards Canadian equities, as well as followed by global equity and then emerging equity. So the beautiful thing about this slide is that it really lets you see just how truly global and balanced this portfolio is. And if you think about it, with Canadian equity and as well as US equity within the global equity bucket, and then the EFI, which is the international allocation, this essentially covers off the entire world map. Now, I will point out that if you are looking at the conservative portfolio. There is no allocation to emerging markets or small caps because, I mean, just based on historical data, they are the most riskiest out of the other buckets. These portfolios all hold ETFs, and they really just vary in weights depending on which bucket you're looking at. And then at the bottom half of the page, starting with the green bucket, so the Canadian Universe bonds, here's where the fixed income piece kicks in. And you can see the majority of the weight in each portfolio is really in the Canadian Universe bonds, but there is a carve out for the corporates and high yields, which if you recall, Kevin mentioned or showed you earlier, both are outperforming the governments. On the next slide here, this is just blowing up the 60-40 balanced growth, which is, I guess, the most popular or the most heard of from most investors. And this really shows you how we are stacked in each bucket with respect to the benchmark. So it lets you see, for what reason, we might have the 100, basis points outperformance on the year-to-date column that you can see at the bottom left corner. So currently, we are underweight Canadian Universe bonds that you can see on the right side of the slide. So how you can look at this is the number in the middle bar, the middle column, shows you the benchmark weight. And whether or not we are on the left side of the bar or the right side shows you whether we're over or underweight that respective bucket. And then the orange number and the green number on the both ends shows you the maximum weight that we can have in that bucket. So it's really just give or take up and down 10% from the benchmark. So currently we are overweight. This is at the very top of the blue bar. We're overweight Canadian equities as well as global equities, and we are underweight emerging markets. So if you recall, Kevin showed you Canadian equities as well as US equities are actually the top performing regions on a one-year basis. And inside the global equities bucket on the previous page you saw, we currently have an allocation in US as well as international. So really these two allocations help the performance out dramatically, as well as the underweight in fixed income. So that really was a call on the global on a macro play, whereby we just believe that equity would outperform fixed income. So that overall call, as well as the tactical allocations, as well as the tilts that we had in each bucket, led us to the outperformance that you see. So that's the global ETF portfolios. Now I'll finally finish off with the North American focus equity. So this portfolio really launched about a little over a month ago. So there is no performance data available given it's still under 1 year. But I'll tell you the story of how the portfolio originated. So when Kevin and I started at Canaccord, we put out this top picks list on the Canadian US side on a monthly basis. And then with increased demand and just more eyes on it, advisors started asking us to put weights alongside each pick. So it almost transformed into a portfolio, if you will. And then when it got to that point, given great results and even more demand, a lot of people were wondering, why don't you just turn it into a product? So that's how this portfolio came about today. And we do manage Canadian focus equity as well as a US focus equity individually on their own accord. So although there is no performance data for this portfolio essentially is the makeup of the best ideas that Kevin and I have on the Canadian side as well as the US side on a monthly basis. So if you're looking for exposure to North American equities, to high quality, large cap, blue chip companies, the top in all the respective corners of the world, then this portfolio is probably something you should take a look at. In terms of the benchmark, it's a blend of an equal weighted 50-50 S&P 500 and TSX index. And in terms of the strategy, so we like to use a multidisciplinary approach whereby we use fundamentals, technicals, as well as quants, and we overlay a momentum piece to that. So we really get the best of all the worlds. And then, but most importantly, our process is very systematic. So that gives us a very unbiased view of the universe. And we found that that has tremendously helped our performance. In terms of how many holdings, so you'll typically find around 25 to 30 holdings, and each weight will range around 1 to 7%. I will say that what's unique about this portfolio is that you'll sometimes find ETFs in there that replaces multiple stocks. And having ETFs, really cost-efficient, liquid ETFs by high-quality providers really allows us to replace and reduce our number of holdings, reduce transaction costs, and it just makes it a lot more manageable while maintaining the same quality. On the next slide here, this is just all the holdings, but I will say that this portfolio has no mandate in terms of what the maximum or minimum weight is on each sector, but we do not make large sector bets. So you'll typically find us never, very rarely having no weight in a certain sector. Now, let's say we flipped a few years back and we are once again in that multi-year energy downtrend, then you might see us possibly having no weight there. But as you can see, inside financials, you have Royal Bank, so the #1 bank in Canada, as well as JP Morgan, which is the #1 largest bank on the US. In the ETF section, this goes back to the ETF that I mentioned earlier. You can see we have a 19% allocation to ticker TECB, which is Evolve's FANGMA ETF. Now this really, so FANGMA stands for those that don't know, Facebook, Amazon, Netflix, Google, Microsoft, and Apple. Now, at first glance, you'd probably be surprised that you did not see those names in the respective sectors, and this is because this ETF itself holds equal weighted stocks in weight in each of those 6 stocks that I mentioned. So it's a really efficient and cost-effective way to getting allocation to those names. I won't go over everything, but if you have time afterwards, take a look at the specific names. But yeah, that's the 2 portfolios. And if you have any further questions, feel free to reach out to your advisors.
Thanks for that, Meng and Kevin. And for the number of you that are on the line right now, if you have any questions, feel free to type it in the comment section below. And happy to ask Meng and Kevin that. Right off the top of my head, we have seen the rush into interest rates, into longer dated bonds and flattening the curve a little bit. What do you see as a driver behind that?
Yeah, I mean, it's a good question, and I mean, personally, I've been somewhat surprised that the 10-year has gone from kind of 170 all the way to kind of 125. So that's obviously good for bonds. And now we're starting to see the 10-year kind of work its way back up. So I think if the market were to sell off, we'd see we'd see some activity in bonds for sure. I think I don't think that rates are going to go up anytime soon, and I think I think inflation, a lot of people want inflation to be transitory, meaning that it's only going to be here for a little while. But those are the 2 big things that the bond market is wrestling with: is what will the Federal Reserve do in terms of raising rates? And it looks like they're going to be on hold for a while. So the next issue is just, inflation. And if people feel like inflation is going to be around and start to pick up, you're going to see that they're going to want a higher coupon, which would mean that rates will have to go up, or bondholders are going to demand a higher rate. So I think those are the 2 things to focus on, and it's yet to be kind of determined whether inflation is transitory or not. Many people are hopeful of it, but as we see people coming back into the workforce, and I read something today about the people that are in the service industry. So those people that when you go to a restaurant, they serve you, and a lot more of those people are getting are either leaving the industry to get a job that's higher paying, or they're demanding a higher, higher compensation or higher wage. And so, it's one thing to get your hair cut and pay a little bit more, but when somebody takes a job, people's pay rarely goes down. They'll just go find another job. So I don't think it's as transitory as people think. And as a result, I think that the bond market is likely to they're going to demand a higher rate, and that would be somewhat negative for fixed income holders. That's just the reality of it.
So what are some alternate things? I see you guys in infrastructure and other investments on the ETF. What are some alternative strategies that you utilize in the ETF portfolios and others to offset that? We're starting pretty much from the bottom of yields. What do you see differently that you haven't seen maybe in past market cycles with this one than then?
Yeah, so I mean, one of the best hedges in an inflationary time is to own things, and that can be hard commodities like copper and real estate. They tend to do well, and also owning businesses. So we would point people to just high quality companies, dividend paying companies. If you were to take the Royal Bank's dividend yield, I haven't looked at it in a while, but it's kind of 3.5% to 4%, which is kind of 4x or 2x what the 10-year is. So if people are looking for yield, definitely go into high quality REITs. You can buy an ETF that'll give you a basket of REITs. Infrastructure you see is in our portfolios. Another way, kind of depends on whether you need income, like monthly income, and what that number is. But you can own, an ETF called the Dividend Aristocrats that'll pay a dividend. But yeah, I think you want to protect yourself against inflation. You need to own things, and in particular equities. And then to solve for the the dividend part or the income part, dividends is obviously a good piece of that. But another piece that rarely gets talked about as sort of investment professionals is people just simply need to save more or spend less. And nobody likes to hear that, but that's the reality. If you want to make your savings last longer, those are probably the two biggest levers that any one individual can pull to have a dramatic impact on their retirement.
What are some of the things that are keeping you up that aren't necessarily getting the proper headlines that they should be, whether them be positive drivers or negative drivers, and just on the global market scale or landscape?
Yeah, I'll answer the question, and maybe Ming can take this one as well. I think the biggest issue that nobody's really talking about is this supply chain disruption, and I think it has the potential to push the global markets into some kind of bear market, or definitely a pullback. So we showed you, on our very first slide, we showed you how strong the Canadian and U.S. markets were, but that China was one of the weakest. And if you remember, the COVID virus started in China. China was kind of came out of that. They were the first to come out of the coronavirus, and but now they're kind of back into it, and that has real implications for all of us. So much of our goods come out of China, and that whole supply chain is being somewhat disrupted. I don't know if anybody's on the calls tried to buy a car or lease a car or rent a car or buy a used car, but the used car market, the pricing there has gone up in sort of commensurate with buying a new car. People don't want to take transit as much anymore, but also there's just not enough chips to go into all of the technology-rich vehicles that we all drive today, and as a result, there's just no supply on the new car market. So these types of distortions, as much as we're hopeful that they're somewhat transitory again and will be resolved, if they persist, I think could have a dramatic impact, and it looks like that they are having a bigger impact than people maybe want to think about, and it's probably best evidenced in how weak the Chinese market is. Maybe I'll hand it over to Meng.
Yeah, thanks, Kev. No, I'd echo all of that, and I would just say I have two. So the market side, and then obviously the actual economy side. As we all know, those two aren't always the same. But on the market side, I would just say, obviously a big phenomenon that we all experienced last month was, how does the index look relatively healthy, but some of our portfolio holdings that we had just kept falling. So if you took a look at the equal weighted S&P index, you would have saw that it's because that index actually didn't move much, and most of the move was concentrated in the FANG names or the larger cap names in tech or communication services. So although valuations and some of the names that got hurt did get reset in a way, but there's still a lot of speculative money, if you will, in my opinion, in some of the bubble-like names. Like, for instance, names that have no revenue before this COVID liquidity pump, where, if you recall, in 2020, almost all the stocks, went up. Some of the valuations, in my opinion, that have no revenue still have not reset or come down enough. So I feel like, although investors feel like valuations have reset, the reality is I think some of them might still be a little bit higher out there. And then in terms of the economy, I think, we've all heard this many times. Some of the local restaurants or the bars that you're seeing downtown or in your favorite places, they're having trouble hiring people. They're having trouble paying workers. Now, I know, a lot of the folks that were fortunate enough to, keep their jobs, keep everything the same during COVID, the only thing they're hoping for is rushing out and dining out and feeling normal again. But then you got to wonder, the people that are working there and letting this happen, how much are they getting paid? How happy are they to work probably with less staff, less friends, but probably get paid marginally just a bit more. So I think eventually that inequality has to get balanced out somehow. And that impacts the actual sustainability of our labor force, which impacts the long-term sustainable growth rate. So I'm really curious to see how that really plays out and how long this trend stays on. And you've already seen some companies that purposely decided to close their doors just because they can't have the capacity of workers that they want there. So without sacrificing quality of service, they decided to shut down. So this obviously all impacts money supply and an economy, and these are probably the two things that I'd be concerned or worried about right now.
So one of the things that Kevin, we spoke about 5 years on this in terms of how you manage money and how you've kind of your mindset developed around it. And it was a discussion about technical traders shorting a stock that you wanted to own and wanted to love, and really brought you into your three-cornered approach and some of the proprietary numbers and algorithms and sorts to get you where you guys or get your next ideas from and balance your portfolio from. Can you just talk more about your investment process and how you come about these names and some of the background screenings and other things that you utilize to construct your portfolios?
Sure. No, it's a very good question. Yeah, we use a very disciplined approach. All of the work that we do is back tested. So I'm a really big believer in what's called evidence-based investing. So, you may be walking around thinking that a particular approach works, but you need to back test that approach and make sure that it really holds up. And investing changes over time. But a lot of the tools that I use, you're a product of your experience and what you've been exposed to. But I started with a very strong fundamental background. I worked for a firm that really prided itself in doing a lot of fundamental work on companies. We would spend several months on one company, analyzing them, reading about them, and then we would take large positions in them. So that was early in my career, and then over time got exposed to quants, where you're screening the market for certain factors. Companies that are profitable, that have strong balance sheets, that have strong earnings, and then kind of in the latter part of my career, we saw people use what are called technicals or charts with great skill to improve the returns of their portfolios and their clients' money. And so we as Meng Gao highlighted, we use a multidisciplinary approach. It's very similar to what RBC Global Asset Management uses, and I was there for many years. So not surprising, I would use a similar type approach, but we use, fundamentals, quants, and technicals, and then, we're investing in, some of the larger companies in the index, so we don't get too far away from the sector weights. But there's no what I like to call trick shots in our portfolios, where all the companies that we own are in the index. They've been selected by people and have been run through a screening process because they're in the index. They're solid companies. And then what we find is that our approach puts us into good companies, and even good companies can not work. A great example would be Microsoft. Microsoft, didn't go anywhere for like 8 years. People forget that. The stock didn't work for 8 years, and then we've seen just an incredible run over the last 3 or 4 years now. But there would be a long period of time where Microsoft just didn't work. And so as a portfolio manager, if you were invested in something else you're generating a better return and a stronger return for your clients. And so we'd like to think that our discipline protects our investors on the downside. It also puts us into high quality companies that are generating real earnings and real cash flow, but also that those companies are what we call working, so that they have strong technicals as well. But I don't know, Meng, did you want to add a little bit to that?
Sorry, Jeff, I forgot the original question.
Oh, just I guess what's different about our investment approach maybe versus other professionals?
Oh, no, yeah, no, certainly. I would just highlight, the multidisciplinary approach is extremely strong. I mean, it's utilizing the best of all the methods, I guess, in a way out there. I also, as Kevin mentioned, he came from a fundamental background. I also come from, mostly fundamentals, and, worked at a private equity shop, which did models, all day on spreadsheets. So that's really in terms of projecting and overlaying your thoughts and from the economy, on the business, onto a spreadsheet, and then coming out with a number. And then technicals is more so chart reading, and then quants is using systems and numbers to sort of come up with a systematic way to rank the stocks in your universe, so that you can unbiasedly select the stocks that are just ranked higher. I think a lot of portfolio managers out there like to impose their view, and a lot of the view is very biased, right? You think about a lot of us and our experiences are made up of what we've seen, what we've experienced, and how we've approached a certain stock or a certain sector or a certain scenario or event in the past. So that bias and experience will have a lot of impact on your decisions. And I think by keeping things in a very systematic way, it doesn't matter, let's say the next day you wake up and you heard the news and you just have a strong distaste towards a certain sector, right? You don't come into work and then decide to liquidate your entire position in that sector. You follow your rankings, and then you follow it in a very systematic way. And like Kevin said, we backtest everything. So yeah, everything, there's a history and there's data and there's proof on everything that's been done. So I think by keeping things not under one way and keeping it very multidisciplinary, it gives you this way to grab little piece and benefit from each and every one of the different approaches.
Hey, Kevin, Raheem here. A couple of questions, probably a little bit more macro, but a little bit more exciting, I would think, in terms of what COVID had brought to us. I look at life as almost a blessing in disguise at times. We go through a lot of difficult periods, but a lot is learned on the back end of that. So on the supply chain question and potential implications, thoughts on, more and more companies globally looking at China as not an end route anymore in terms of manufacturing capabilities. They're looking more to the US. I think Trump, when he was in power, he was definitely campaigning on the notion of repatriating manufacturing. And then the second question, and a question we get extensively, especially going through COVID and looking at younger investors who are prioritizing saving and had a time to look at the markets and look at investing. Thoughts on cryptocurrencies. There's a thought that it's fly by night. It's something for now, but not for later. And yet the infrastructure behind decentralized finance continues to get built out. And then you have companies like Goldman Sachs who are now starting to bring in product and solutions and ETFs into the mix. Thoughts on what you guys are looking at in terms of potentially bringing an exposure into that asset class, but keeping in mind that risk is always something that's paramount.
Yeah, so you sort of got two questions there, just kind of longer term question around supply chain and then crypto. So I'll take the first one just around supply chain. Yeah, I mean, like if you're probably the best example would be some of the large chip makers in the US that built out manufacturing facilities. And like these are decisions that, are made by management. They have long lead times. They're big capital expenditures and they're not done quickly. So, when you start to shift the supply chain, I think everybody is somewhat, like we all know that we're kind of just in time inventory, but we all got reminded of just how just in time we are through COVID. And, just the example of the toilet paper fiasco early on, just kind of shows you how easy it is to disrupt the supply chain. So, I think it's too early to say how much will change, but definitely if you're in manufacturing or you're in relying on China or the emerging markets in some level, this whole thing has caused you pause, and sourcing things locally looks a whole lot better than it did 18 months ago. So I think it's a little bit early. I mean, the best analog I have is I was in I was traveling for 9/11. So I was actually in New York for 9/11 for a conference. And, on a personal level, it had a tremendous impact on me. And I remember people saying, well, air travel's forever changed and the world will never be the same. And, for a period of time, that was true, but I don't think anybody gets on a plane these days and necessarily thinks about 9/11 the way they did, 5 years ago or even 10 years ago. So I think people are quick to kind of draw these conclusions. People thought that we'd never shake hands again. I was at an event last night where people were shaking hands. So we're not even out of COVID and people are shaking hands. So, I think we're always very quick to say things will change, but I think they tend to stay the same a lot longer than maybe we fully appreciate. Then just on crypto, I mean, the challenge there is just, I think it's here to stay. What it looks like and how it impacts our life, will be seen or yet to be seen. I think when you look at crypto as an investment instrument, it has this great alpha to it because it's gone from $3 or 30 cents to 45,000 today. So when you put that into a global macro model or any kind of multi-asset model, it's additive to alpha. But a lot of the professionals and professional money managers that we talk to about this are just not there yet because can you really invest in an asset class where a couple of people can move that currency or investment 20 or 30% in a relatively short period of time. So we can talk about whether crypto is an investable asset. We can talk about whether it's a diversifier in a global macro portfolio, but the Federal Reserve wishes that it had the impact that Elon Musk would have on crypto. They can only wish that they would have that kind of impact on interest rates or on currencies. So there's things that need to be worked out, and I think as investment professionals, we probably would default to letting people at this point do that in their own accounts, and it's not something that we would necessarily incorporate into a professionally managed portfolio, and mainly just because of the volatility. We can't have something that goes down 30-40% in a portfolio at this point, and really not primarily based on sentiment. If we could be clear about the underlying value and how that value is created and when it could be overweight or underweight, but if it's being pushed around by tweets, then it becomes almost not really investable in a fiduciary product, shall we say.
Perfect. I think we're up on time right now. I really appreciate you sharing your thoughts and your strategies with us and our clients. For those of you participating, this has been recorded. So if you do want to watch this later and review some of the things that are going on and some of the points that Kevin and Meng touched on, check your emails in the coming days. And with that, thank you, Kevin, and thank you, Meng, and we'll be chatting soon.
Great. Thank you so much, gentlemen, and have a great rest of the day.